This is Fundamentals of Income Tax Part 7, and we're going to be looking at Chapter 6 of the textbook. For those of you who haven't listened to a recorded session online before, my name is Brian Clark, and this is the material for people in the British Columbia region. So our examples when we are speaking about provincial things are going to be drawn on British Columbia. That said, last few sessions, we've been looking at provincial examples. Now we're moving back to focus primarily on federal, at least for the next session or two. All right, so that said, welcome back everyone. Here in British Columbia, we had a holiday yesterday, but it is now Wednesday, October 1st. The spooky season has begun. There was one year I wanted to come to the tax office dressed as the Grim Reaper so that I could tell clients that there are two things in life that you can't avoid. But sadly, that was only the 1 year where I was working on Halloween. That said, let's enjoy autumn and all our various pumpkin spice themed drinks. As always, everybody, if you have any troubles hearing me during the session, do let me know. I am working with a new computer, new headset this time, so exactly do that. Nothing is certain except death and taxes. Exactly. Now, that said, remember this checklist here if you do get booted out of the session, particularly the part about needing to say yes when WebEx prompts you with the voice conference question. All right, but the new headset seems to be working reasonably well. So let us dive in. All right, as always, just a reminder to everybody that all questions are welcome. There's no such thing as a bad question. There is sometimes a question which is a little bit out of scope or something that we can't get into right now. But those kinds of questions I'm always happy to take offline or in the email. Also, we always do respect class time, so this session is going to end more or less on time at 9. There's very few things which require us to run past 9 o'clock. All right, in our previous class, we looked at the BC Form 428 and the BC Form 479, and we finished our discussion of how provincial taxes work and how they plug into the parallel system. And basically, the provincial Form 428 is a parallel calculation which closely follows Step 5 of the federal tax return, former Schedule 1. And the BC 479, like all provincial 479 forms, is for refundable tax credits for that particular province. And in British Columbia, the main refundable tax credits we're going to encounter at this level are for the BC sales tax credit and the BC renters credit, and you may also encounter the BC home renovation tax credit and the BC training tax credit for individuals, although those are less frequent. And we will be discussing at least one of those in a future session. With that in mind, we are now able to complete the entire tax return all the way through Step 6 to determine if someone has a refund or a balance owing. So we now know how to do a tax return for somebody, at least for a basic scenario involving income and credits related to employment. And last time we also looked at moving expenses, which were a big component of chapter review problem 5-2, which last time we had a main look at that. If anyone's got any questions left over from last time and the chapter review problems, let's save that for the chapter review problem session of tonight's lesson. But any other questions on the theory side of it? If there's anything that anyone's unclear about, just feel free to let me know. If not, we are going to now start to expand the kinds of income, the kinds of credits that we look at. So tonight we're going to begin by looking at two new kinds of income, workers' compensation and social assistance, which are treated similarly for tax purposes, as you'll see. We're also going to look at the income side of the Canada Pension Plan and the EI system. So what happens previously, we've looked at when someone has money withheld from their paycheck in order to contribute to the CPP or the EI system. Now we're going to look at what happens when people receive payments from those systems, and occasionally what happens when somebody has to repay benefits from those systems. And then we're going to look at a new type of tax credit for charitable donations, which, although it is entered in Step 5, Part B of the main tax return, is not calculated at a flat 15%, as you will see. And we're going to continue to look at other miscellaneous things that are still not too far removed from what we've been discussing so far. So we're going to look at claiming deductions for legal expenses. We're going to look at examples of other income, and we're going to look at the refundable tax credit known as the Canada Workers' Benefit and how that is handled. So by the end of this chapter, you should be able to explain what the difference is between workers' compensation benefits and social assistance when we report them on the tax return. They are very similar with a one or two small differences, which will sometimes come up. We'll also know how to handle the reporting for CPP and EI on the tax return. And when somebody has to repay EI benefits, we'll know how to handle that on the return. You're going to know a great deal more detail about charitable donations, the kinds of legal fees that we can claim on the return, the kinds of other income that we may encounter on the return, and the line 25600, when we may be able to claim for that, and lastly, eligibility for the Canada Workers' Benefit. All right, but with that in mind, as I was saying before we started recording, self-test number 2 is one you should have done. So those of you recording at home, if you haven't done that self-test yet, go through and select your answers and then resume listening, because we're going to go through now. All right, so first, question number 1. Carol is 17 years old and single. She lives with her daughter, and her net income was $5,000 last year. So the question is, will she be receiving a GST/HST credit? All right, so let's set our timer for 1 minute, and let's see what you all think. And of course, remember, the HST is simply the term for the federal sales tax as it applies in those provinces, unlike British Columbia, which have a harmonized sales tax. And again, harmonized just means that the federal sales tax and the provincial sales tax apply to exactly the same things, which is not the case in British Columbia. But for purposes of various credits and rebates, whenever you see GST/HST, it just means the federal sales tax as it applies in that particular province. All right, a few people haven't answered yet, but most people have, and I can see that most people are coalescing the correct answer, which is always good. Right, so I'm just going to send out the results to you guys. And the correct answer is yes. So most of you remembered that while you start to become eligible to receive GST/HST credits when you turn 19, you can receive them earlier if you have a spouse or you have a child, right? So in that case, effectively, you've become an adult a little earlier than otherwise. All right, good job. Most of you did that. All right, for question number 2. Oh, yes, that's right, Valerie. The income component is going to be there. And in this case, her income's only 5,000, so she would be receiving the basic GST. Yes, exactly, Valerie. Good clarification. Okay, for Cynthia, her employer transferred her to a different city 400 kilometers away. The employer gave Cynthia a fixed moving allowance, but she had eligible moving expenses that exceeded this allowance. Should she be completing Form T1M? All right, again, let's set our time limit for 1 minute, and let's see what everyone thinks. And we're going to open our poll there. Right, again, I can see that people are mostly coalescing around the correct answer. Right, but a few people haven't responded yet. There we go. All right. Yes, fantastic. Okay, so again, most of you got the correct answer, and the answer is yes. So the key point here is that the expenses exceed the allowance. So in a case like that, you can always claim moving expenses, assuming you meet all the various other conditions for claiming moving expenses. Whether the allowance is included in your taxable income or not, if the expenses exceed the allowance, they can be claimed. And again, if the moving allowance is included as a taxable benefit on your T4, then you can claim all of the expenses. But if it is not included on the T4 as a taxable benefit, then effectively the employer has paid for those expenses directly. You are not out of pocket for the amount that was covered. So in that case, you can only claim the excess. All right. All right, question number 3. Rebecca. So Rebecca has been divorced since 2022, and she purchased a condominium in 2024. Before the divorce, she owned and lived in a home together with her spouse. So let's make sure I've got the correct full question here. There it is. All right, so the question here is she eligible to claim the home buyer's amount? Yes or no? Okay, so now I have the correct question queued up. WebEx sometimes likes to display them out of order on my end, you see? Right, so we set our time limit. So yes or no? What do you guys think? All right, here, about 20 seconds left. A few people are still thinking hard. There we go. And most of you got the correct answer. The answer here is no. Now, Sam, assuming she had claimed the home buyer's amount before, actually, it's not based on whether she's claimed the home buyer's amount before, it's simply based on whether she lived in a home that she owned during the current year or the previous 4 years. So her current marital status is irrelevant. In 2022, she lived in a home that she partially owned. Okay? So whether she owned it by herself or together with her spouse, is irrelevant for this question. So she would be ineligible for that reason. All right. Okay, question number 4. This one's got a few different answers for it. Where is it here? There we are, question number 4. All right, so Marcello has a net income of $180,000. Calculate the personal amount that Marcello can claim on line 3000. Oh yes, so Muhammad is just asking for the previous question. If she purchases after 4 years from her divorce, then will she be eligible? Again, it's not about the marital status. It's whether she was living in a house that she owned. So 4 years after she leaves that house, divorced or not, right? It's entirely possible the divorce could happen later or earlier than her leaving that house, right? So it's all about, did she live in a house that she owned or owned part of? All right, so for question 4, then, it's going to involve a little bit of math. So for Marcello, what is his basic personal amount that he can claim? Is it $143.11? Is it $1,405.89? Is it $14,156? $61.89 or $15,705? All right. Let's see what everybody thinks. Timer is set for 1 minute. Let's see what you think. Right? 26. Right? A few more people didn't respond this time. Probably because they're still doing the math. But not to worry. So the correct answer here, and I'm going to show you how we got this in a moment. The correct answer is E, 15,561.89. So how did we get this figure? For bottom 3 tax brackets, that is, if your income is 173,205 or less. Oh, get back here. Trying to annotate this. Thank you. Right. So if your income is less than 173,205, then you claim the entire amount, 15,705. So Marcello, his income is 180,000, so he is in the 4th tax bracket. So the amount he can claim is going to be prorated. If the income is in the top tax bracket, 246,752, then you would claim the minimum of $14,156. So obviously we can tell that Marcello's answer is going to be somewhere between the two. Now, because his income is much closer to the bottom of the bracket, we would expect the figure to be closer to 15,705. So how do we result at the calculation? So the difference between the figures between 15,705 and 14,156 is $1,549. So to figure out how much of that he gets to claim, we need to figure out how much of his income is in this bracket, how much of the bracket is taken up by it. And that's done like this. So we deduct the bottom of the bracket, 173,205, and this means he has 67.95, so $6,795 in the fourth bracket. So to figure out, and this figure here, if it's not clear, that is the fourth bracket. So the fourth bracket is on the $73,547 between 173,205 and 246,754. So what we want to do is express this as a fraction. So what is 67.95 divided by 73,547 as a percentage? That is 0.0923899. Now this is a percentage. We don't round it to 2 decimal points. It's not a dollar amount. It's a percentage, and we want it to be as exact as possible. So if you're calculating that as on your calculator, use as many decimal points as you can. Right? So this is the percentage of the 73,547. That percentage of the 1549 is what he can't claim. So 143.11 is deducted from the 1549. So he gets to claim, however, he still gets to claim 1405.89 plus the base amount of 14,156. So his basic personal amount is going to be 15,561.89, which again is pretty close to the maximum, but he is 67.95 into the fourth bracket. Good. Thanks, Beanish. All right, so all clear now, Mohammed. There's a lot going on here, but basically, once we put in some numbers and run it, we can see what's happening here. Basically, we're just trying to figure out of this 1,549, what is the percentage of that he can't claim. Yeah, this is what I mean when I sometimes say when we look at the blank forms and the blank worksheets, it could be a little difficult to figure out what's going on until we put some numbers in, and then we can see what the calculation is designed to do. Okay, so on that note, let's go to our last self-test question. So, and this is for Nadine. All right, let me pull this up here. There we are. Let me set the timer. All right, so for Nadine, so here we're giving you a chance to do a calculation for step 5, part C. So Nadine has a net and taxable income of $100,000. The only non-refundable tax credits that Nadine has are for the basic personal amount, EI premiums of $1,049.12, base CPP contributions of $32,1750, and the Canada employment amount of $1433. So, in other words, the CPP contributions, EI premiums, those are at maximum. All right, what is the net tax going to be? And let's move this window, make sure it's not in the way. Is it A, 3,210.69? Is it B, 14,216.63? Is it C, 17,427.32? Or D, 21,404.62? So let's open up the poll. Let's see what you think. And again, we're going to show you the solution in a moment. All right, so here the correct answer is B, 14,216.63. Right, and WebEx is just tabulating results. All right. And again, I see most of you were able to get that. All right, so again, let's show you how that's calculated. So first of all, we would realize that the taxable income of $100,000 is going to put someone in the second federal tax bracket. So to calculate the tax on that, step 5, part A, in other words, $100,000 minus 55,867. That's the amount over the bottom bracket times 20.5%. So that's tax on the second bracket plus 83,8005. That's the tax on the first bracket from that first column. So total tax of 17,427.32. And again, just because we can't show the diagram here, it looks a little compressed, but that's what we are seeing here. So that's the result from step 5, part A. Then the total non-refundable tax credits, step 5, part B. So that's 15,705 for the basic personal amount, 32,1750 for his Canada pension contributions, the base contributions, 104,912 for the Canada employment amount. 104,912 for the EI premiums, and 1433 for the Canada employment amount. All of that totaled together and then multiplied by 15% gives 3,210.69. So the net federal tax then is the federal tax on taxable income from step 5, part A, minus the non-refundable tax credits from step 5, part B. So 17,427.32 minus 32,10.69 gives 14,216.63. All good, everybody? All right. And again, if there's any questions, we can plugging those numbers into step 5, part A and step 5, part B will give this result. Okay, so good job. That's our self-test. Now, let's see what everyone's past experience is like. So let's see which of you have had to deal with some of the following tax situations. So how many of you have made a charitable donation? Okay, all right. So some of you have, some of you haven't, and some of you have but not claimed it. Okay, all right. Well, I may have some good news for you about that. Oh, Nida. Ah, charity in your country. Yes. Ah, okay. I may have some information for you. Okay. So let's keep that in mind. And have any of you received any of the following income? So, EI or social assistance or workers' compensation benefits? Okay, so some of you have, and for many of you, they're going to be new. Okay, I can see that. Now, have any of you ever received EI benefits, but there was an overpayment and you had to pay some of it back? Okay, so that one's a little less common. All right. Well, we're going to be talking about that. Oh, Urja did? Okay, okay. Uh, so we're going to be talking about that as well. And lastly, have any of you received the Canada Workers Benefit? Okay, all right. So we're going to be talking about all four of these things tonight. But before we do, based on what you know, based on what you have learned so far, which of these is an income result amount? Which of these would be a deduction? Which would be a non-refundable tax credit? And which would be a refundable tax credit? So if you like, we can go in order. Let's start with the income amount. Okay, so EI would be income, definitely. If you're receiving income, so it says right here, received income. So EI, social assistance, workers' compensation, these are all kinds of income. Okay, BLAB. Okay, the charitable donation tax credit. Okay, so for charitable donations, charitable donations are a non-refundable tax credit. So if charitable donations are a non-refundable tax credit, then what would be a refundable credit? So Canada Workers Benefit, so this is money that you receive. This is the refundable credit. An EI overpayment happens when you receive EI and then you have to pay some of it back to the government. So that then is treated as a deduction because you didn't get to keep the income. We're going to be all right. Let's begin with workers' compensation benefits and social assistance. Now, these two types of income are um, relatively common, and what they have in common is that they are treated as income, so they are reported as income, They are included in total income, but they are not taxable, as we will see. But they are treated very slightly differently on the tax return. So as you can see, they are recorded on a form called a T5007, and this is a very simple form. All that's on the form is the year, the tax year, the name and address of the typically governmental agency which is paying them out, and then the recipient's name and address, and then there's either an amount in box 10 or an amount in box 11, plus the social insurance number. So workers' compensation benefits first. So for anyone who's unfamiliar with the term, workers' compensation benefits are benefits which are paid out to workers who are injured while on the job. These may have slightly different names in various provinces, depending on the provincial issuing organization. In British Columbia, the organization that administers and issues workers' compensation is called WorkSafe BC, formerly known as the Workers' Compensation Board. In different provinces, there may be different provincial entities. These benefits are reported in box 10 of a T5007 slip, and they are included in net income, but not included in taxable income. So they are entered on line 14400 and deducted on line 25000. Right? So they're going to be included in the net income calculation. And remember, net income is used to calculate eligibility for various social benefits. So this will have the effect of boosting your income for terms of calculating a GST, HST payments. So this may well be beneficial, but it also boosts your family income when calculating your eligibility for things like the Canada Child Benefit or being able to claim childcare. Someone injured on duty or at work, right? So not necessarily on duty, but during working hours doing your job in some ways, right? As opposed to being at home, right? So if I am in an H&R Block office and and the ceiling falls on me, then I can get a workers' compensation claim. If I fall off a ladder at my house, I can't. And if I'm at home teaching you this class from my home desk and the ceiling falls on me, I probably can't either, because that workplace is not H&R Block's responsibility. But those are the kind of situations where things can get a little gray. For example, if you are working in childcare and you are taking a class of children out for a field trip and you are hurt, then you are considered at work even though you're not in the workplace. So work hours is usually the main determinant. Now, sometimes, as you can already tell, workers' compensation claims can be complicated, and they can take time to resolve who's at fault, how much to be paid, and so on. So sometimes, after an employee has been hurt and can't work, the employer will continue to pay them while waiting for the WCB to show up. So in that case, the benefits might show up on a regular T4, even though they should be workers' compensation benefits. So in that case, any income reported on the employee's T4, then when the Workers' Compensation Board repays the employer, then it'll be reported in a box 77, and a corresponding deduction is claimed on line 22900. Right. On the way to work. Now that, I think, is a good question. For some purposes in tax, being on the way to work, commuting to work is considered your own time. But if you're in a company vehicle during work hours, uh, then that would be covered. So, right? So I think the main determinant would be work hours. Although once you get more than one insurance agency involved, like you could have ICBC and WorkSafe trying to, they might dispute who has to pay the claim. So those kind of complications to them. If the mistake happened from the employee side, I don't think that's frequently an issue. That said, that sort of determination would be made by WorkSafe. So for our purposes, we don't need to get too far into that. I'm sure WorkSafe has information about that on their website. It is definitely not the case that they just rubber stamp everything and pay out in every single case, but generally it's for workplace accidents. So the question of employee responsibility tends not to come up. So if the employer pays you while waiting. So good question, Urja. So let's say let's give an example. So let's say that you are working in December for an employer and you're hurt while on the job. So the claim is submitted to the Workers' Compensation Board, but it takes them more than the usual amount of time to process it. So maybe it takes 2 or 3 months for them to pay. So during that gap, the employer continues to pay you your regular wages on the understanding that the Workers' Compensation Board will be repaying them. So in a case like that, the wages will show up on your T4 as regular payments because they will have gone through as regular payments, but there will be a corresponding amount on box 77 which corresponds to the amount of the wages that are from workers' compensation payments. Okay? It's important to understand that this is different from what we were discussing earlier for wage loss compensation payments. So this is only applicable for cases where there are workers' compensation benefits, which are independent of wage loss compensation benefits, right? Wage loss compensation benefits can apply in cases where there would be no workers' compensation claim. So they might apply in cases of sickness or other conditions where someone was unable to work for whatever reason. Maybe the employer, there's a fire and the employer, they can't come to work for a few weeks, and so the wage loss benefits come in that case. So just from a tax point of view, this is a distinct category. All right. The key point about these benefits then, they are included in income, but they are then deducted after net income has been calculated. And in this regard, they are similar to social assistance. Now, social assistance, so workers' compensation benefits are reported in box 10 of a T5007 slips. Social assistance is reported in box 11. And again, this is also non-taxable, but it is included in net income. It is entered on line 14500, but also deducted on line 25000. Social assistance is different in this regard. If it is received while you're living with a spouse or common law partner, then it must be reported on their return if they have higher income, but only during the time when you are living with a spouse or common law partner. So there may be situations where you receive some benefits while you are not living with them and some benefits while you are living with them. So in a case like that, the income needs to be prorated and allocated for those given months. That's a little bit unusual, but it is common enough that it's worth mentioning. Now, the purpose here is so that they are included in the spouse's net income for calculating personal amounts and entitlement to certain social benefits, such as the GST credit. In most cases, this is going to be a net benefit to the couple. All right, but workers' compensation benefits, this doesn't apply to at all, and they are claimed by the person who receives them. Now, because this proration is sometimes necessary, if you do run into a situation where someone is receiving social benefits and was living with a spouse for part of the time, then you have to be careful when you're using tax software to make sure it's entered correctly, because it can, not all software packages have been set up so that they will handle this situation correctly. And again, it's a slightly unusual situation, but it's definitely not that uncommon or that rare that software shouldn't be able to handle it. But you do need to be careful to make sure the software is handling it correctly. All right, so those are two types of income. Next, we're going to look at Canada Pension Plan benefits. Now, previously, we've talked about contributing to the Canada Pension Plan. Now we're going to look at the income side of it. Now, these are reported on a T4A slip, specifically a T4A P slip. Now, the P is for pension, so that's easy to remember. And again, anything that has a T4 in it is broadly related to income in some way, most of the time. So Canada Pension Plan benefits are based on the contributions you made while working. So that also helps us remember there. Now we're going to discuss these individual boxes on the next slide, but for now let's just talk about the general layout. So tax years over on the left, and the recipient's address will be here. This is always issued by Service Canada, so we don't need information about that. Along the top are kind of the summary boxes. So total benefits are over here, and then the total of months where someone is receiving disability or was retired are recorded here for proration purposes, and any income tax deducted is reported here. Now, box 22 for income tax may be blank. You should always, however, check carefully to see if there is an amount there, because it's easy to just skim over a T4AP and just say, oh, total benefits, plug those in, and not check to see if there is income tax, because income tax deducted here is discretionary on the part of the taxpayer. So taxpayers who have chosen to have income tax taken off here will be very annoyed with you if you forget to include it when you're doing the taxes. So I once had to apologize profusely to a client because one of my well-meaning but very new colleagues had just kind of brushed over that. So do be careful. Watch out for income tax being deducted here. Now, once you start receiving retirement income, in particular, the default will be for Service Canada not to withhold taxes. So this is why some pensioners opt to withhold the taxes. So again, it's at the taxpayer's discretion. It's something to keep an eye out for. Now, box 20 here is the total benefits. It is the total of these boxes on the right, which we're going to talk about now. So there are multiple benefit types, boxes 14 to 19, and the sum of the amounts, again, is shown in box 20. It is the box 20 amount, which is entered on line 11400, and then any tax deducted in box 22 is included on line 43700. Now, as for the specific boxes, you will see on the right, we'll just touch on each of them in turn. Now, it's not really possible for someone to have all 6 of these kinds of benefits on the same form, as you will see, but it is definitely possible to have more than one. Just my notes fell down. I just retrieved those. Okay, so the box 14, the retirement benefit, this is the most common benefit that people are receiving. So after they turn 65, or if they opt to when they're 70, they will begin receiving the retirement benefit based on the contributions they made during their working career. Box 15, this is received when your spouse is deceased, but the spouse contributed to the CPP. Deceased returns are beyond the scope of this course in general, but that's what that is. The main thing to be aware of there is that you can only receive this benefit up to a certain maximum, so it will top up your benefits, but you will not necessarily receive the full amount your spouse was getting. It'll simply maximize what you can get. Disability benefit, this amount is entered for information purposes on line 11410, but otherwise it is included in box 20 and it's not used for other purposes. The child benefit, box 17, is when there is a deceased parent. So if your parent contributed to the Canada Pension Plan and passes away while you're still a minor, you will receive their Canada Pension Plan benefits. Now, these we're going to talk more about this in the next session, but this income, income that children receive is not always considered their income and is not always attributed to them. Often it is included in the parent's income, but child benefits here are an exception. So this is considered the income of a child, and this is even if the surviving parent is receiving the money on the child's behalf. So this is important to be aware of. It is considered the child's income for tax purposes. And again, this is different from many other kinds of income that children receive. Question from Cinder. If you are not a minor, so if you're not a minor and your parent dies, then you will not be receiving the child benefit. However, there is a death benefit, and this is a flat amount. I forget the exact amount now. I think it used to be $2,000. I think it may be $3,000 now. But if someone passes away, then the person who is the executor of the estate or their surviving spouse receives a flat payment of $2,000 or $3,000. I forget. I need to look that up. We don't have it in the notes here. You receive a flat payment, and this is intended to defray the cost of funeral expenses. $3,500? Okay, it's gone up then. But the key thing is it's a flat amount. So it's not, there's no requirement to keep the receipts for the funeral expenses. And it is also received, it takes a little time to process. Obviously, funerals, you often have to pay for things right away. So this money can take some time to arrive. And box 19, post-retirement benefit. So this applies when someone starts to receive CPP when they retire, at 65 if they have opted out of CPP. But if they keep working after age 65, then any contributions they make after turning 65 will kind of give this bonus benefit, post-retirement benefit. So basically, this is for when you're working after you start receiving the CPP. All right, now let's look at one other thing which can arrive with CPP benefits. Now, CPP benefits sometimes, in some cases, take time to be approved. I imagine this could happen in cases, for example, when someone needs to file their tax returns for certain years in order to collect their CPP. So if someone hasn't been filing tax for several years and needs to catch up on that, then the CPP benefits may get held up until the relevant tax returns are filed and the CPP is approved. So it's possible then for a taxpayer to receive multiple years worth of CPP payments all at the same time. Hang on. Well, that's interesting, Valerie. Where are you reading that? I wonder if there's been a change about the death benefits. Okay. 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 That top up. Okay, so in unusual circumstances, there might be a top up. Okay. Yes. The ones I've been encountering have been just the basic flat amount, but that is possible. All right. Good to know. Good to know. I'll make a note of that. Again, we're not getting into deceased returns too much in this course, so it's probably not a bad idea to make note that in the instructor notes here for next year. Okay, thanks, Valerie. All right. Anyway, so for CPP benefits, when they've been held up for some long process, and a taxpayer receives multiple years worth of them at once, that could conceivably be quite a large amount of money, and that might put them into higher tax brackets. So if this happens, here's how it's handled. The entire amount that is received in the year has to be entered on line 11400, and if there's any disability component, that's going to be on line 11410. The CRA, unlike other things in tax, there will be no adjustment of prior year tax returns. However, they may recalculate the tax payable this year if the total income for prior years is $300 or more, and the result of the calculation is beneficial to the taxpayer. Right? So in other words, when we encounter this situation, we, preparing the tax, do not do any of the calculations ourselves. The CRA will handle it, and the full amount of CPP is recorded as usual. The CRA will handle that. Essentially, there's a process. The CRA will work through it. If necessary, a letter can be sent to the CRA to prod them to do it. This is distinct from the regular process for adjusting returns, which we're going to talk about in Chapter 15. Right? The key point here is the CRA handles it, and there's no need for calculation on our part. So in a case like this, typically you would receive a letter from Service Canada showing the amounts related to prior returns, prior years, that is. So the best way to handle it would be to file a paper return, attach the letter, and just request that the CPP look at it. A question about CPP. If someone discontinued a few months before reaching retirement age, what would be the consequences, Mohammed? Sorry, stopped contributing to the plan, you mean, Mohammed? Okay. I do see your question, Valerie. Hang on. So the CPP you receive is based on the contributions you make. So, and the formula, I think, varies a little bit from year to year. I haven't checked on what it is currently, but basically it looks back at your working career up to the last 40 years, and then it takes a certain number of years, your highest earning years with your highest contributions, and uses that to determine your highest average wage, and uses that and then bases your CPP benefits on a percentage of your highest wage. So you want to report as much as possible for a certain minimum number of years in order to maximize your CPP pension. So just not contributing for a few months is not generally going to have a huge effect one way or the other. Now, Valerie, you're asking, is there any way to attach letters to online submissions? No, not directly anyway. There is a mechanism where you can use CRA My Account or represent a client to upload documents for the CRA, but in general, that is a little bit limited in the kinds of documents you can upload. So I don't think you can specifically attach this kind of letter to it, but the upload is completely independent of the tax return. So in some cases you can upload a document, but it's not the same as attaching it directly. It kind of goes out independently, so it could happen at a different time. And this can typically, it's either for a few set things that the CRA is expecting, or if the CRA has sent a letter requesting documentation or receipts or things like that, then they give you a reference number that you can include when you upload something. But I don't think it's possible in this particular case. All right, so those are CPP benefits. Again, we enter those on line 11400. EI benefits, again, are handled a little bit differently, although the slip is a little bit different. All right. So these are reported on a T4E slip. Again, T4 indicates that it's related to employment in some way, and the E is for employment insurance benefits. Now, as you can see, the layout is somewhat similar to the T4AP, but there are fewer fixed boxes. So any amounts over here are always going to be included in the total benefits paid in box 14. So just like a T4, box 14 is the amount that is reported. But there's some other things going on here. So box 7, the repayment rate, this is always going to be 0% or 30%. We'll talk more about that on the next slide. Box 22 and 23 for income tax. This is often, but not always, blank. So you should always check carefully to see if tax has been withheld. Quebec income tax, that's because the T4E is used for all provinces, including Quebec. And in the case of Quebec, the Quebec income tax that is deducted is calculated and reported separately on the form than the federal income tax. There are more kinds of benefits for EI than there are for CPP, so that's why these boxes over here on the lower right are open format to handle various things for other information. And these boxes up here, though, 15, 17, 20, 21, these generally are included in box 14. So box 14 is the total of all the benefits. All right. Most notably, the thing to mention about EI benefits is that EI, as a federal program, used to be known as unemployment insurance. So the change to the EI label is relatively recent, um, in the last 20 years or so, I believe. One key thing to understand about EI is that although it is insurance against losing your job, it is also used for purposes such as paying parental benefits during maternal leave, paternal leave, and so on. And it's also used for things like job training. So this is why we have boxes here for tuition assistance, for example. In Quebec, and this is one of the main variations between the Quebec system and the system in the other provinces, in Quebec, EI is only used for job loss purposes. There is a separate program called the PPIP. I think it's the Paid Parental Insurance Program, which covers maternity, paternity leave, paternal benefits in Quebec. So for this reason, the percentage of EI deductions that are withheld are different in Quebec than the other provinces. Essentially, historically, Quebec, that federal rate in Quebec is split into two components, and EI in Quebec is only the job loss component. All right, so again with EI, there are multiple benefit types. The total benefits paid are shown in box 14. Any repayment rate is shown in box 7, and then any benefits that have been repaid are shown in box 30 and then entered on line 23200. And any tax withheld is reported on line 43700. Again, we want to watch out to see if there's any tax that's been withheld. With EI, generally the federal government withholds tax, but it withholds it at a lower percentage than regular wages. Philosophically, what's going on here is the government assumption is that if you are receiving EI and certain other kinds of income like pensions, but EI in particular, the government assumption is that if you are receiving EI, it is some kind of unusual financial situation, maybe not a full emergency, but you are probably not receiving your regular income. So the EI withholds less tax at source for that reason. The government assumption is, hey, you probably need more money up front now, so we will settle up any tax you do owe at tax time. So instead of withholding 20 or 25%, they will only withhold 10%, if they withhold anything at all, in general. Now, when we talk about EI benefits being repaid here, it's important to make a distinction. Now, there's two times where EI benefits have to be repaid. The first is if during the year you mistakenly receive more benefits than you're entitled to. This will appear on the T4E. So in this case, the amount that has to be repaid is typically withheld from the EI benefits you receive. And whatever is repaid is either shown in box 30 or in rare cases on a separate form called a statement of crown debts repaid. Any amount that has already been repaid, that is, you didn't really receive that money, you got it and then you had to give it right back, is entered as a deduction on line 23200. As we're going to see, sometimes this is different from the repayment rate up here, because sometimes you receive your EI benefits, but your total income for the year is high enough that the government will determine that, you maybe did not need so much help, and then it will have to be repaid later at tax time. This is calculated on the tax return itself, and we're going to talk more about that on the next slide. Yeah. Okay. So, all of these benefits, however, your box 15, your regular benefits, Box 20, taxable tuition assistance. 21, non-taxable tuition assistance. Box 17, employment benefits, support measures. These are all included in box 14. These boxes are just for information purposes. The box 15 number here, this is what is subject to so this is subject to the repayment rate up here, as we're going to talk about. And box 17, that is when you have EI-funded financial assistance and you're taking part in an approved employment training program. Box 17 amounts are exempt from repayment. They never need to be repaid. Training assistance, we're going to talk about in Chapter 13. Essentially, that's a kind of assistance with tuition at a post-secondary education. So if you're going to get some retraining at ACIT or something like that. Box 21 is adult basic education training assistance. So these are high school level courses. Those are not eligible for the tuition credit. However, it is then deducted on line 25600 because it's not eligible for the tuition credit. And since 2019, just mentioning here, any EI benefits that are for maternal or paternal leave, these are, or the provincial PPIP, are reported on the tax return for information purposes on line 11905. But typically, in those cases, the taxpayer will also receive a letter from Employment and Social Development Canada telling them what to include on the line. Okay, now question from Mohammed. I can see a few questions here. Sorry, this. So is the repayment with or without interest? Without interest. At least we'll talk more about it's just going to be included in the amount of tax that, if any, that's due at the end of the tax return. We'll talk about interest on that later on in the course. Maternity benefits, generally no. So generally for parental benefits, they're not subject to that. There may be no benefit, no number in box 15 and only in box 14, and the repayment rate is generally 0. All right, but let's talk about that more in a moment. So, explain the repayment rate. So, social benefits repayment is the term we use here, and it applies to two things. In tax, it applies to EI benefits and it applies to old age security, which we are not discussing today. So this repayment comes in if someone's net income is over a certain threshold. Remember, the assumption with EI is you're receiving EI because you're in some kind of temporary, theoretically, temporary financial hardship. You lost your job, the employer's gone out of business, some other thing like that. So the government is paying you these benefits. If, however, your net income for the year is over a certain threshold, and I sometimes see this, their net income is $140,000 for the year, but early in the year they got thrown out of work and they went on EI and then found another job right away. So in cases like that, then repayment can be triggered. And again, this is how much needs to be repaid is determined by the repayment rate in box 7, which is either 30% or 0%. So regular benefits are subject to 30%. So this 30% is calculated and included on line 42200 and thus added to total payable. And then a corresponding deduction of the same amount is included on line 23500 so that it's not included in net or taxable income. So in other words, if $1,000 of your benefits you had to repay, you don't have to pay tax on that $1,000 It's not included in taxable income. You just have to repay the $1,000 and it's added to total payable. Now, clawback is the term that's generally used to refer to this, and that's an unpleasant term, but I think it's helpful because there are the two kinds of repayment, right? There's repayment during the year when you receive too many benefits by mistake, and then clawback is for the repayment at tax time when it turns out your taxable income for the entire year was over a certain amount. Now, social benefits repayment is what we use to refer to EI and old age security in general. Here are the specifics for EI. So it applies only when the repayment rate is 30% in box 7, and it applies only to regular benefits in box 15. And the repayment threshold is $79,000 for 2024. And the repayment is the lesser of either 30% of the regular benefits or 30% of the net income greater than $79,000. So you're never going, so that would mean then it is, you're never going to have to repay more than 30% of the benefits. Now, old age security is different, as we will see when we get to that. All right, now some things and so again, anything you have to repay is then, it's included under total payable on line 42200, but again, it's also deducted on line 23500. So anything you don't get to keep, you also don't have to pay tax on. All right, points we want to emphasize. So again, the repayment depends on the EI benefits in box 15, not total benefits in box 14. Sometimes I've had questions from people, sometimes coworkers, where they've never collected EI before, they receive a T4A, and then they are confused by it. They have to think, oh, 30%, I need to pay 30% tax on this? And it's like, no, that's not it. Or they think, oh, 0%, I don't have to pay tax on this? It's like, no. So it's important to stress to people sometimes that the repayment rate is not the tax rate. It only applies if you have regular benefits in box 15 more than and your total income for the year is above $79,000. I should say total income, but as we'll see, this calculation happens after your initial net income has been calculated. So some deductions come into force before the calculation is made. All right. Ooh, a poll question. All right, let me pull that up and have a look at this T4A while I do that. Right, and now we set our timer for 1 minute. So this taxpayer has $88,000 of net income, including this T4E. Are they going to be subject to EI clawback? Yes or no? All right, let's open up the poll question and see what you think. Right? So most of you have answered. In this case, the answer is no, because the repayment rate is zero. Right? Now, there's no information on the T4E to indicate why the repayment rate is zero. It's not always obvious what the condition is that made it so that the repayment rate is zero. But if the repayment rate is zero, then no repayment is necessary for whatever reason. A common reason is if it's for parental benefits, but it might be some other Service Canada reason. Okay. All right. Let's see where we are. Okay. So we're just going to get through charitable donations and then take our break. Although if that runs too long, we can just take a break anyway. So for charitable donations, these are a non-refundable tax credit, but there are a variety of rules around them. Now, we've already talked about political contributions, so it's important to remember that charitable donations seem similar but use a fairly different set of rules. So, first of all, they have to be supported by official receipts or appear on information slips. So, on the T4 itself, there is a box for charitable donations. So you may see some, and that's when somebody is donating to a charity through their workplace. Either way, the total charitable donations receive a non-refundable tax credit of 15% on the first $200, and then anything over $200 receives an additional credit based on what this taxpayer's top income is. So if their income is in the top bracket above 246,752, so this is unclear, but it refers to their income. Then, so if they're in the top tax bracket, then they get 33% credit. Otherwise, they get 29% credit. The provinces provide an additional provincial charitable tax credit. In most of the provinces, except for Alberta, it follows this federal pattern. In Alberta, essentially it's reversed, so that the provincial credit on the first 200 is higher than the amount above that, but otherwise, currently, the federal all follow this pattern of your first 200 giving you the flat benefit of 15%, and then anything above that giving you a benefit at the top tax bracket rate that you're subject to. All right, other things to mention here. Now, the donation must be a true gift, as we were talking about the concept of advantage with political contributions. A similar concept called consideration applies here. So again, say, for example, you buy a house in a home lottery, then part of your ticket is a donation, and part of it is the cost of the lottery ticket. So you can only claim the donation purchase. Now, donations can be claimed by either spouse or common law partner, and they can be combined. So often we will want to see who needs the donations more. I have occasionally had to explain this to clients who get upset. They don't understand why the software wants to do something a certain way, and then I have to explain that either spouse or partner can claim it, and in this particular case, by having one spouse claim it, they avoid paying tax entirely for a past year and thus avoid interest and penalty. So considerations like that can come into it. Another thing about donations that's important to keep in mind is that they can be carried forward. You have up to 5 years to claim charitable donation. So for those of you students who said you've made a donation but you haven't claimed it if it's within the past 5 years and you still have your receipt, then you still could. The actual charitable donation credit is calculated on Schedule 9. There is no provincial Schedule 9. Instead, it's calculated on a provincial worksheet in most provinces, at least in BC. Okay, anything else? Oh yeah, so that for that 5-year limit, we'll talk more about that in a future slide. But first, some other rules. So first, usually donations are limited to 75% of your net income. That's not going to apply for most people, but let's say you come into an inheritance or win the lottery or something like that, and you're tempted to say, aha, I will just donate my entire year's income to charity and thus avoid tax that way. This is obviously more of a consideration for wealthy people who are trying to avoid tax, but in most cases, donations are limited to 75% of your net income for the year. However, for certain really valuable donations, so cultural property, ecologically sensitive land, and so on, then, or donations made in the year of death or the immediately preceding year, then the limit is 100% of the net income. There's also a special carve-out in the tax code for members of religious orders who've taken a vow of perpetual poverty. They can donate all of their earned income and pension benefits to the order, and that is claimed as a deduction on line 25600. This received special mention in the tax code. I think this probably, so it's probably a historical provision which has been there a very long time. In practice, it's rarely encountered, but you may be working in an area where there is a monastery, so this may come up. So it's important to be aware of it. All right. Now, again, as I say, donations can be carried forward, so you can claim them in the year or in any of the 5 subsequent years. And similarly, if you have donations from previous years you haven't claimed, you can claim those in the current year as well. The main thing is, bear in mind, if you, say, claim a $100 charitable donation for 2023, and then later on you find an additional charitable donation for 2023, if you want to apply that to 2023, you need to send a copy of both donations to the CRA when you're doing the adjustment. Otherwise, you can just take the second donation and apply it to the current year. Now, carrying donations can be useful in a variety of cases. Obviously, if you don't owe any tax in a given year, then best to carry that forward to a year when you do, because they're a non-refundable tax credit. You can also combine multiple years to take advantage of the increased credit above $200. Important thing to be aware of, though, is that the donations are not tracked on the tax return or sent to the CRA. So if there's any carry forward, there's no record of it with the CRAs, so whenever you do claim it, the receipts will potentially be required. Okay, right, and the types of organizations you can claim from. After the break, if you like, we can dive into this more online. But for Canadian donees, these can be registered charities, amateur athletic associations, art service organizations, and then a few other things. So, for example, most universities and schools are recognized as charities. Housing corporations, you can also donate it to a government, so municipalities, certain journalism organizations, Gifts to Canada, province, territory, and so forth. Those are usually treated as claimable donations. Now, for foreign charities, the list is much more restricted, except for U.S. charities, which we'll talk about in the next slide. For charities outside the U.S., the only organizations for which donations qualify are the UN, universities, which normally have Canadians in their student body, and registered foreign charities to which the government of Canada has made a gift. That list is extremely short, and it varies by year. because it depends on whether the government of Canada made a gift in the year. For U.S. organizations, it needs to be either to a college or university where the taxpayer was enrolled or someone in their family was. Other organizations that are recognized as U.S. charities, however, it can only be claimed against any U.S. income the person has. Now, some investment income often comes from the U.S., so many people have U.S. income without realizing it. So if, for example, you donate to a public television in the U.S., that's a U.S. charity, but if you have investments returning U.S. income, you can claim it. And commuters, these are people who live in one country but work in the other. So people who live in Canada but work in the U.S., donations to U.S. charities can be claimed if the U.S. employment is their chief source of income for the year. There is a parallel provision under the U.S.-Canada tax treaty for people who live in the U.S. and work in Canada. All right. Now we can go more into donations after the break if you have questions about specific types. Just trying to get to the break now. A couple other things we're going to touch on briefly here. So legal expenses. So this is a type of deduction. Legal fees are usually not deductible unless they are related to income in some way. And again, remember I said this is a general principle in tax. You can only claim expenses, deductions, things if they're related to income in some way. So legal fees, unless they're related to income, either business or property, usually can't be claimed. So under that provision, certain personal legal fees can be deducted, and they are claimed on different lines of the return depending on what the type of fee is. All right, and there's more examples in the textbook. After the break, we can have a look at that if time allows. But we are going to encounter various other legal fees as we progress through the course. Additional deductions can be claimed on line 25600 of the tax return. These are kind of miscellaneous deductions where they don't have a specific line in the tax return. So any kind of oddball deduction will show up on line 25600. So the vow of perpetual poverty I just mentioned, this shows up on line 25600. Things like income, which is exempt under a tax treaty with another country, also shows up on line 25600. For example, some of your U.S. Social Security benefits, if you receive those, are exempt under tax treaty and will appear here. We're going to talk about that later in the course. All right. Okay, so on that note, we've reached our break. So if anyone has any questions, then we will look at that after. Oh, and Valerie had a question about maternity benefits. Are there no tax? Well, no, maternity benefits paid out on a T4E are still taxable. So that 0% just refers to the repayment rate. So they're not subject to clawback, but they are still taxed in the regular way, Valerie. Okay, so on that note, it is 7:37, which I think is about in the ballpark where we want it to be. So let's break. We'll cover the lecture material, then I'll give you another little break. So for anyone who hasn't had a chance to finish or take a crack at the chapter review problem, I'll give you a few minutes to do that, and then we'll go through that as well. All right, welcome back, those of you joining us online. We will finish talking about our theory portion, and then we will look at the chapter review problems. Okay, so let's begin with a poll question. Let's see how well everyone has absorbed everything. So make sure I've got the correct poll question here. There we go, and let me set our timer correctly. All right, so Saffron has no dependents and is single, and her only income is 12,000 of employment income and 2,000 of EI. So how much will she save by making a $100 donation and claiming it on her tax return? Zero, $150, or neither of the above? Let's see what you think. All right. Yeah, the poll's open. Oh, you're not seeing it? Some of you are seeing it. Maybe you minimized the window. Anyone else have trouble not seeing the poll? Okay. Well, let's keep an eye on that. Of course, the polls are just to give us a general idea. Okay. All right. So in this case, Saffron, the key thing we want to look at here is your overall income. So her overall income is 14,000. So this means her income is less than the basic personal amount. So this means her tax has already been reduced to zero. She won't save any additional tax by making a donation and claiming it on this year's return. Now, if she has already made the donation, she can carry it forward to a future year. Now, this is an important principle to remember. The non-refundable tax credits in step 5 have to be claimed in order. So if someone's tax has already been reduced to zero by the time you get to a certain tax credit, then you cannot substitute in that tax credit. And this has important implications for when we are going to talk about tuition. So in the case of tuition, if you make a charitable donation, you can't say, because tuition never expires, you see. So if you have a charitable donation, you can't say, aha, I will claim the charitable donation instead of claiming any tuition. That's actually not discretionary. They have to be claimed in order. And the basic personal amount comes before everything else. Okay, now let's have a bit of discussion. So how would you answer this question if someone asked for your tax opinion? How much money can I make before I have to pay taxes? Any ideas? How can we answer this question? What sorts of things could we say? Based on what you already know. Good. I'm seeing some good answers here. So deductions are important, but the key question is how many credits someone has. Because While every dollar of income has to be reported and is potentially taxable, almost everyone will get tax credits. Not everyone will get deductions, right? Not everyone has deductions. So for all full year Canadian residents, generally, they will get the basic personal amount. So they can earn up to $15,705 before they have to start paying taxes. And then there's other ones we can include as well. If they're working, Canada Employment Amount at $1,433. EI, CBP contributions also come into play. So for someone, for your average taxpayer then, $15,705 plus $1,433, there's a minimum of $17,000, maybe up to $19,000 before someone has to start paying taxes. And if they qualify for some other non-refundable tax credits, that amount could be even higher. So this is unique for every situation, but when we are talking to people about tax, we can generally internalize this point. You are allowed to make at least $15,000 or so before you have to start paying taxes. So in a whole question like the previous one, we can just look at it and say, this person is not going to have to pay taxes, therefore they won't benefit from a charitable donation. And this is going to come around in other situations. So the question there was, will this person get a refund? The other half, because that is a related question. Somebody will say, am I going to get a refund? Back button, please. Thank you. So key point is she's had tax deducted, $700. So if she is not liable for any tax, then all of this tax will come back to her. It's a key point that if someone hasn't had tax deducted, they won't necessarily get a refund because these are non-refundable tax credits. Often I can see situations where someone's overall income is relatively low. They have several small jobs. So $2,000 here, $5,000 there, sometimes 4 or 5 small T4s that all together add up to $20,000 or $21,000. And what can happen in situations like that is none of the individual jobs take off very much in income tax because all of the individual jobs are assuming that this person is going to have less income than their tax credits. So in a situation like that, you could have someone who has relatively low income and isn't subject to that much tax, but none of the jobs have withheld tax, so they wind up owing tax at tax time. So the question of whether someone has a refund also connects to whether the person has had tax withheld. So it varies a lot by person, but these are the sorts of factors we have to consider and keep an eye out for. As we go through the course, we're going to be identifying more and more non-refundable tax credits and more situations. But that's kind of the basic dynamic. Now, let's talk a little bit more about, sorry, before I move on, any other questions about that? Okay, the one thing which might not be obvious is that when you are hired with a new job, there is a form you fill out to tell that employer what tax credits you're going to claim. So that tells the employer how much income tax to take off. If you're not careful when filling out that form, there is a box on the form to tell the employer you have more than one employer, and so for your second, third, fourth employer, you tick that box, and then those employers know that you have more than one job and your actual income is going to be higher than the basic personal amount, so they should take off income tax. Not everyone's aware of that, though, and so that can lead to situations where you have these second, third, fourth jobs where very little income tax is being taken off, but the person's overall taxable income is going to be above the basic principal amount. All right. Now let's talk about some other kinds of income. So just like there's a line for miscellaneous other deductions, there's also a line for other miscellaneous types of income. And these are referred to as other income, and they are reported on line 13000. Important to note, this is not to be confused with other employment income, because other employment income is employment income and qualifies for the Canada Employment Amount, is used when you're considering moving expenses and so forth. So other income is just miscellaneous income which doesn't fit anywhere else on the return. Usually it receives no special tax treatment, so it doesn't qualify. It's not employment amount, it doesn't qualify for the Canada Employment Amount. You can't claim investment expenses against it, you can't claim the pension income amount against it, and a lot of other things that we will encounter. Basically, other income is just miscellaneous income. There's no special treatment. And there's a variety of examples. So, death benefits are one. Now, these are non-CPP death benefits. So earlier when we were talking about CPP death benefits, it's important to bear in mind that that was only for the death benefits paid out by the Canada Pension Plan. Other death benefits may come from private insurers, an employer's insurance, things like that. In general, the first 10,000 of these non-CPP death benefits are tax exempt. The net amount over and above that is reported on line 13000. So these are life insurance payments and similar payments. Basically, when you receive a receipt from the company, you would look at that and say, oh, okay, what T-slip did they put it on, if any, and then if it is a death benefit going on this line, i.e. it shows up in box 106, then only the net amount over 10,000 is reported. Other things we may encounter: gains from illegal proceedings, theft, embezzlement, and so on. These legally have to be reported on line 13000, and a deduction can be claimed if any amounts previously reported are repaid. Now, this might seem silly. Why would a criminal report the profits of their crime? But remember that this is a tool that governments use to crack down on criminals, famously, such as Al Capone. Someone receives income illegally and then doesn't report it on the tax return. It's difficult to prove sometimes that a crime was committed, but it's relatively easy to report that income was received and not reported on the return. Federal income support for parents. Now, this is it's infrequent that you see this, but it's important to know what it is. So what this is for, this is aimed at the victims of crime. So parents where there's been a crime committed against children. So we need to handle this very delicately if we encounter it. The key thing to bear in mind here is it's none of our business why the income has been received, unless the taxpayer wants to discuss it. And it's important to remember, if you're doing tax for other people, either for H&R Block or in your personal life or for some other company, although why would you want to? Regardless, when you're doing tax for anyone else, it's important to maintain a high standard of professionalism, empathy, and just respecting people's privacy. Tax is one of the most personal services you can provide for someone, so we need to respect that. I have done tax for people in a variety of very very difficult life situations. And it is an honor to do that and a privilege to be able to assist them at a difficult time. So, it is something you need to hold yourself to a very high standard if you're helping people with anything like that. Now, the apprenticeship incentive grants, we were touching on this earlier when referring to British Columbia. So these are for the Red Seal trades. In general, when you complete a year of an apprenticeship or the entire apprenticeship, you will receive an incentive grant in Box 130 on a T4A. So the basic amount is $1,000 per year. For women, it's $3,000 per level. It's a separate thing. And upon completion of the grant, it's $2,000 after the completion of the program. Generally, however, all of these are reported in Box 130, and this is reported on line 130. This is different from the provincial refundable tax credit, training tax credit. That needs to be applied for on the tax return itself. These apprenticeship grants are applied for through the federal government. All right, and lastly, any other amounts. There's a variety of examples in the ink doc. Oh, hang on. Yes, Mohammed? Okay, Mohammed. I did touch on this, but just to be clear, the criminal will report the income so that they cannot be charged with tax fraud. So, for example, let us assume I am a very successful white-collar criminal, and I'm so successful that no one can prove I was involved with any crime. But it's relatively easy for the government to prove that, for example, there's $5,000 in a bank account that I can't account for, where that came from, or what it is. And they can prove that I had some kind of income that I didn't pay tax on. So criminals will opt to report this income without specifying where it's coming from or what the purpose is. And there is a variety of other income which can show up on line 13000. In fact, let's take a look at it. So it's in the textbook. Just to show you the kinds of miscellaneous income which can show up here. So it's kind of a grab bag. So, retiring allowances that show up on a T4, but they're not employment income, so they can appear here. We're going to talk about those later. Other retiring benefits that you receive in a lump sum, they might show up here. But also jury duty payments would show up here. Certain other amounts from investment slips, so on a T3 slip or a T4A slip. Generally, any kind of investment income that does not qualify under the investment income category. So that we're going to talk about in our next session. So basically, income from an investment which isn't on a T-slip, right? So that is what this would look like. And certain other cases where a registered plan becomes deregistered, for example. We're going to talk more about that later. And just in general, any other reportable income that's not reported elsewhere on the return all shows up in this category. So if your criminal out there might say, "Oh yes, this is an investment. It's a mortgage I have with a friend," and so on. If the CRA asks about it. All right. So we're going to touch on the Canada Workers Benefit. This is a refundable tax credit, and as the name implies, it's available to working low-income individuals and families. It used to be called, I think, the Working Income Tax Benefit. There was a name change about 10 years ago. but mechanically it's the same benefit. Um, it can vary by province, but currently, and British Columbia used to have its own variation, but it's now been brought in line with the federal guidelines. So currently only Alberta, Nunavut, and Quebec have their own versions of the Schedule 6. All the other provinces use the same federal Schedule 6. And there's also supplement if someone has a disability. And the total amount of this refundable credit is claimed on line 45300. Now, this is based on your working income, not your total income. It is intended to encourage people to be working, so it is targeted specifically at people with employment income, which is another reason for the important distinction between other income and other employment income. Right. Let's see, what order do I want to do this? Right, so I think let's have a look at the textbook. I think there's an illustration there which might be worth looking at, and then we can go through the slides. All right, we're going to go through. Okay. All right, slides first, I think. And Diane is asking, is working income synonymous with earnings, or how do they differ in definition? That's a good question. Do we have a good definition here? Yes, so it's the total income from employment and business, excluding losses. It can also include tax-exempt working income earned from various things. So, for example, your Box 87 exempt honorarium for an emergency services volunteer would be considered working income for these purposes, and any taxable portion of someone's scholarship income. So they're not necessarily earnings, although most of the time working income is going to be synonymous with working earnings, right? But there are a few edge cases where something might be income without being a quote-unquote earning. All right, but that's a good. This illustration. Get back here. Okay, so now there may be a clawback here, but it's not. Confusingly, it's not. It works differently from the clawback for EI or old age security. It's not treated as a social benefits repayment. So let's go through some of the various things. So first of all, to claim it, you need to meet the following conditions. You need to be resident of Canada throughout the entire year. You need to have earned income from employment or business, and those few other cases we talked about, and you need to meet the threshold. So you need to have a certain minimum amount of working income, and your income needs to be below a certain other threshold. Just as with the GST payments we talked about earlier, if your income is above a certain level, then the amount you receive will start to be reduced. You also need to be, similar to GST, you need to be 19 years of age or older, or you need to reside with an eligible spouse or common law partner, or living with your child at the end of the year, or the partner's child for that matter. So again, that's very similar to what we've seen with the GST credit and the BC provincial sales tax credit. One thing I want to flag right now, although we haven't talked about spouses and dependents and detailed situations yet in the course, I want you to keep in mind that when we're talking about a spouse or child for any given credit, these terms have precise definitions. So who is eligible for a certain credit may vary depending on a given credit or benefit. So someone who qualifies as a spouse or eligible dependent for one credit might not qualify for another credit, and vice versa. All right. Now, there are some restrictions on the Canada Workers Benefit. A big one is that you cannot be a full-time student. So if you're a full-time student, you're not a full-time worker. And that means you are working as a full-time student. You are a full-time student for more than 13 weeks in the year. That is more than 3 months of the year. So unless the taxpayer has an eligible dependent, and we'll talk more about that when we get to dependents, essentially that's if you are a single parent, you can think of it, is the most common example of that. So a single parent going to university, then you are allowed to claim this credit. So if you have an eligible dependent at the end of the year, then you would be able to claim it. Also, as we've seen with some other credits, you cannot claim it if you were in prison for at least 90 days during the year. Again, philosophically, because you weren't working for the entire year. And also if you're exempt from income tax in Canada because you're an officer or a servant of another country, all right? That is a diplomat or diplomat's family. So when we calculate the CWB, a question can arise of who has to claim it. So if both spouses are working and both spouses qualify, then one of the spouses will claim, but not both of them. If one of them has been receiving Canada Workers Benefit advance payments, then that is the spouse who will claim it. Or if one of the spouse is claiming the CWB disability supplement, then that spouse will claim it. And if both spouses are entitled to claim the disability supplement, then each claims the supplement and one of them claims the basic CWB. This is all spelled out on Schedule 6. We'll have a look at that if we have time. But just to bring up some images from Schedule 6. So there are some minimums. So for the basic Canada Workers Benefit, you need to have at least $3,000 in working income. For the disability supplement, you need to have at least $1,150 in working income. We're going to talk more about the definition of disability in Chapter 10. It has a specific definition for tax purposes. Then, to calculate the upper threshold for your income, if your income for the year is over one of these amounts, so if you have an eligible spouse or eligible dependent, you enter $29,833. So your income over this amount will start to reduce your Canada Workers Benefit. If not, your income over $26,149 will start to reduce the benefit. And then for the supplement, the threshold amount is much higher. So $48,091 if you have an eligible spouse, if not, $36,748. And if the spouse is also eligible for the disability tax credit, then it's reduced by 7.5% instead of 15%. So what this works out to, when is something phased out? So this is again from Chapter 16. So if your income is above the amount listed in the chart, you're not entitled to the Canada Workers Benefit at all, unless if there's an RC 210 slip, in which case additional steps are required. So if just a single taxpayer, no spouse, no dependent, not disabled, then if your income's higher than $36,749, then you're not eligible. If you have an eligible spouse or dependent, then it's $48,093. The disability supplement has a higher threshold. So if you're eligible for the disability tax credit, then the maximum is higher. And if both you and your spouse are eligible for the disability tax credit, this won't apply because you don't have a eligible spouse or disability or credit or dependent. But instead, if you have a spouse or dependent and you are eligible, it's $53,500, and if you and your spouse are eligible, then it's $59,038. So, as you can see, it's much higher in those cases. Now, a concept that we see with the Canada Workers Benefit in particular is working income for both taxpayers and the family net income. But if both of them are working, there's an exemption of up to $15,955. So if your working income is less than your spouse's income, then you enter whichever is less. And if you're the higher income spouse, then you deduct a certain amount for the spouse who is working. And we can look at that illustration in the textbook if time allows, although I'm not liking the time. I want to get to the other major points. So, the Advanced Canada Workers Benefit, this is an interesting one because this is relatively new. So this used to be optional, and the government made it standard. So in cases where workers are entitled to the Canada Workers Benefit, the government has determined that people in this situation their income's relatively low, so they could use more support through the year. So what happens is the government makes advance payments. In other words, instead of having to wait until tax time and getting a big refund, including the Canada Workers Benefit, because you really could use some of that money earlier in the year, the government will instead make advanced payments of up to 50% of what it estimates the Canada Workers Benefit will be for the current year. This is referred to as the Advanced Canada Workers Benefit, and these payments are issued automatically across 3 payments. This income is reported on RC 210 and transferred to line 41500, only if they qualify for CWB. So you only have to repay it from your CWB if you're receiving CWB in the current year. Otherwise, it's just treated as regular income. It's taxable. So if you have CWB on your 2024 tax return, then you would receive payments in July, October, and January based on 50% of the CWB you had on your 2024 tax return. So let's say you had $1,200 in CWB on your 2024 tax return as a credit. You would then get $600 paid out to you in July, October, and January in 3 payments of $200 each. Now, if there is an ACWB, so you've already received some in advance, then it reduces some of your current CWB refundable credit. In other words, you've already received part of your refund, so your refund will be reduced by the amount you've already received. And if you do not qualify for the Canada Workers Benefit in the current year, they're not required to repay any of the advance payments back to the CRA. It might be treated as taxable income, but it is not repaid as such. Okay. So, with all of that in mind, let's think about a scenario. So, Jordan has 2,130.30 on line 45300 of his 2024 tax return. Let's put our chat window up here. So, is he going to qualify for ACWB in 2025? So, 2130.30 is his Canada Workers Benefit that he received as a refundable credit in 2024? Is he going to qualify for the event ACWB in 2025? So he is going to qualify. So therefore, the question then becomes, what's the total amount he's going to receive for his advance payments based on this figure? All right, so the total is going to be $1,065.15. Very good. So then, what are the payments going to be that he's going to receive, and when? Karina wants to know which amount, Karina? That's right, Nika. So Karina, the 1,065.15 is half of 2,130.30. We then need to divide that into three, which will give us three payments of 355.05 paid out in July and October 2025 and January 2026. All clear? So let's see if you remember. On what slip does he what information slip is he going to receive? And on what line does he need to report the payments? So it's reported on the RC210, and if he qualifies for the CWB in 2025, that's right, Diane, it's reported on line 41500. Okay, so with all that in mind, here we go. So Jordan is going to receive 1,065.15 in advance payments, and they will go on line 41500 if he qualifies for the CWB this year for 2025. But if he doesn't qualify at all, then there is no line entry on line 41500, and he does not have to pay back the 1,065.15. Now, and if it seems overly generous, just bear in mind the purpose of the ACWB and the Canada Workers Benefit in general is to support people while they are working, on the assumption that they could use some support during the year and not at tax time. Now, let's think about it. What are some reasons that someone would qualify for the CWB, or sorry, would would not would not qualify for the CWB? So why would someone qualify one year and not in the following year? What based on what we've discussed, what are some reasons that we might see? Okay, so he has more working income and so wouldn't qualify. Right? So increased income. So that definitely that's a good problem to have. What else might disqualify someone? If their income is too low, right? Or the income they receive is not working income. Uh, so no or minimal working income. Yeah. Good. If he's studying full time, right? Then he's not going to be able to qualify. Prison, yeah, yeah, definitely a possibility. Yeah. 3 months, that'll definitely do it. And there's one other major one. Good, Nika. Yes, if someone leaves the country, they cease to be a Canadian resident, right? Their residency changes, then they wouldn't qualify. Excellent, excellent. All right, good stuff, everyone. So, uh, let's give you one more poll question. Where'd that go? All right. So let's see how well you remember this one. Question 3. There we go. Oops, get back here. Get back here. There we go. All right. So poll question 3. Set our time limit. All right. Okay. So for a married couple, social assistance income, who reports it? Is it reported by the taxpayer listed on the E5007? Is it reported on the higher income spouse, on the lower income spouse, or if they are married, they can choose? So which one of these would apply? Assuming assuming this is a standard situation where someone is living with their spouse. Okay. My WebEx is just tallying the results. Let's share that with everybody. All right, good. So it is going to be reported by the higher income spouse, bearing in mind that this is not taxable, so it's going to raise the net income, and then it will be deducted to give a lower taxable income. All right. The only exception is in the case where they're not living together for the entire period. Good stuff. So on that note, any questions on what we've covered tonight? Right. If not, we've got about 20 minutes left, and that's a little short to go through the chapter review problem. So I'm inclined to we'll introduce the chapter review problem, I think, and then you can work on it over the weekend, and then we can review it at the start of next class. I would like to, however, spend a little bit more time looking at where these things come in on the form and some of the mechanics of it. So let's spend a little bit more time looking at the form itself and at the Schedule 6. So let's pull up a... There we are. There we go. There we go. And pull that over. Okay, so for total income, then, all right. So you can tell me, where do we report EI income? And I think I'm going to let you guys have some fun here. I'm going to allow you all to annotate. So point out on the form where we can do the EI. Very good. Right. So line 11900. All right. Okay. What about CPP benefits? Where are those going to show up? Very good. 11400. Excellent. All right. All right. And you can see here that there's an information line here for disability benefits as well. So if there are disability benefits, we record those here. Similarly, for EI benefits, if some of them are related to parental benefits, those go over here. And the PPIP benefits that I mentioned here, that also goes here. All right. Okay, so will it let me stop annotating? And I want to scroll down the page. Will it let me scroll down the page? Nope. Okay. What? Urja, you're asking a good question. So, Sarab, that's also a good question. Just wait a second. So, although PPIP is paid out by Quebec and for Quebec only, this is for the federal return. So, this is actually an important point, actually. For EI is a federal program, and in Quebec, EI is only for the job loss portion of it, but PPIP is still treated similarly to EI for federal tax purposes, right? People living in Quebec still pay federal tax, still have to file a federal tax return, right? So only Quebec residents or people who are living in Quebec for part of the year would be receiving the PPIP, but it's still reported on the federal return. And it's also, for that matter, included when calculating their non-refundable tax credits for EI. But this course, we don't get into that because it's just we have enough to cover with just covering the basics. And Sarab, you're asking about line 11500, other pension. So that one here, 11500. These are pensions that are non-CPP pensions. We're going to talk about those later in the course because they come in a wide variety of types. Uh, just a good shorthand is this is any non-government pension and whether something qualifies for it. Okay, I want to scroll down the page, so I'm going to turn off the annotation. I have to close the annotation to scroll down. All right, so let's go down a bit. All right, and again, just make sure all allowed. Very good. Okay, good. I don't need to. I have the option of picking one of you out individually, but I don't want to do that. So, can you show me where workers' compensation benefits and social assistance payments are claimed? Very good. So workers' comp goes on line 14400, and the social assistance on 14500. So notice that these are subtotaled down here, right? These are all subtotaled down here and then added in at line 34. Now you might notice that there's a line here for something called federal supplements. We're going to talk about that when we talk about old age security. Essentially, when someone receives old age security, some of it is treated as regular taxable income, but for low income seniors, they also receive a portion of it as this social benefit, which isn't taxable, as we will see, but it is included in total income. Right. Employer pension would qualify as another pension, yes, depending on how it's set up. Okay, so let's move down here. Okay, so for here, now can you show me where the social benefits are repaid? Good. So notice how it comes after we've done the initial calculation for net income. So after all your other deductions, if this amount here is higher than 79,000, then you may have to repay some EI. All right. The only other thing this applies to is old age security, which we'll talk about when we get to seniors. Notice that that has a different threshold. Now, the repayment on that is not calculated on the federal worksheet. Give me a second and I'll pull that up and we can have a look at that. Federal worksheet. Oh, federal worksheet. Right. Scroll down here. Adobe. So this chart is a little bit complex because it has to handle EI and old age security. And so we use the chart if, in either case, if there's EI or the Social Security. So how does it work? First, we total up the old age security. We deduct any of that was deducted at source. And then we have the old age security and the net income. The important thing, we don't need to get too far into this right now, but the important thing to note is that your EI benefits, any repayment of that is then essentially calculated and deducted. So the T4 E-slip itself has a repayment chart. So if there's any repayment, and if you had any income from one of these two sources, which are less common now, so any EI benefit repayment is then deducted before we calculate the old age security overpayment, if any, right? UCCB, this is a older type of child care benefit, which is pretty much not encountered anymore. but a registered disability service savings plan might be encountered. We haven't talked about these things yet, so don't worry about it too much. The main thing I want you to remember is that in this chart, first we take away any EI benefits repayment before calculating any old age security repayment. Remember, EI, so long as you're working, you have to pay into EI, which means you could collect EI at any age, including after you become a senior. So while it's uncommon for someone to have both EI income and old age security income on the same return, it's by no means impossible. All right, let's go back to the main form. All right, so that's where the repayment comes in. Now let's drop down here. All right, and can somebody point out where donations come in? Good. So as we can see, it uses a separate schedule, Schedule 9. When you do the chapter review problem, I think you'll have time to do the Schedule 9. The Schedule 9 is not, well, actually, I'll walk you through it after I'm done with the main form here, because there's a couple things to be aware of. The main thing to notice, though, as you can see, it's not combined with all the other tax credits, and that's because it doesn't give the tax credit at a flat 15%. It's necessary to calculate it separately. All right. And then let's go down here. All right, and let's have a look at step 6 and step 5. So please show me where we enter the Advanced Canada Workers Benefit, if any of that needs to be repaid. Good. So as you can see, that's included in net federal tax at line 42000. Right? And that's because you've already received this money, therefore it's going to be deducted from what you're getting back. But that only applies if you're going to be getting the Canada Workers Benefit in the year. Now, and show me where, if someone has to repay EI or old age security, so where is that entered? So previously it's been entered as a deduction, right? So good. Oh, yeah, there you go. Right. So line 42200. Right. So remember what's happening here. It was a deduction previously because it's not treated as income because you're not going to get to keep that money, so you don't have to pay taxes on it. It is simply added here and included in total payable because you're paying back the money dollar for dollar. All right. We'll talk more about that when we get to old age security a little bit. But mechanically, that's where it all works. And lastly, let's go to our refundable credits portion and just point out for me where is the Canada Workers Benefit in this column. Very good. So mark it up for me. There we go. All right. So notice it says right here, you have to complete the Schedule 6 to calculate it. So this, and again, just so make sure we're all clear on it, this is the amount of Canada Workers Benefit that you are due to receive as a refundable tax credit, and anything that you've already received from this is included previously as the Advanced Canada Workers Benefit. And if you have no amount here, then you won't have any amount back there. And again, it's because the government wants to support you. All right. Okay, so I think Schedule 6, let's close the annotations for a moment. So Schedule 6, I think I'll show it to you, and the Schedule 9, just because those are also a little bit, they look a little bit more complex than and they are. Skip for British Columbia, there is no separate Schedule 6. 10 years ago, British Columbia had different thresholds and had its own version of Schedule 6. It no longer does. So we'll go with that first. So I'll just walk you through it. It basically talks about all of the various conditions that we looked at earlier. So it explains the conditions, it explains when you can and can't claim it, and they list specific conditions for who qualifies as a spouse or an eligible dependent. And we always want to look very closely at this, because this may not be the same as these definitions for other purposes. We don't have time to go through it in detail right now, but please do have a look at that when you do chapter review problems, which include the Canada Workers Benefit. So the form is broken into steps. First step, you have to answer the questions. Are you the eligible dependent? Do you have an eligible dependent? Do you have an eligible spouse? And are you claiming the basic CWB? Are you eligible for the disability tax credit, and so on? So again, this helps determine what your thresholds will be. Then here you calculate the family working income, so your working income, and notice that it specifies exactly what qualifies. So employment income, but also certain other kinds of income which would qualify for this purpose. And you also do this for your spouse, if there's a spouse. And so this gives you the family working income. Tax-exempt income is optional for this Canada Workers Benefit, but there are some rules around that. Oop. So again, you can have a look at the form. There's a lot of, you can really get into the weeds on it. And then notice there's an exemption for the secondary earner. So if your spouse has less than $15,955, their income is not going to affect your net income. Notice here we are now calculating net income rather than working income. So working income is to see if you meet the minimum thresholds. For the maximum threshold, then net income is considered. But again, your spouse has an exemption of $15,955. Again, your maximum net income limits will vary depending on whether someone is disabled or not. And then we have the calculation for your basic Canada Workers Benefit. So it is based on how much income you have. So your income over $3,000, 27% of that is your benefit. But there's a maximum of $1,590 if you're single, $2,739 if you have a spouse or eligible dependent, and then it is reduced by your family net income over the thresholds, either 15% of it, or for the disability supplement down below by 7.5%. Okay, so it's quite an involved form because it has to cover all these bases. Here, the Advanced Canada Workers Benefit calculation, that's much simpler. And lastly, I'll show you Schedule 9. So main thing to look at here, the donations are totaled up here in the various categories. And in the first part, we see if your net income is, basically remember that restriction, you could only claim a maximum of 75% of your net income or 100% in other situations. Down here is where we calculate the credit itself, and it looks a bit more complicated because, again, if you're in the top tax bracket, you get to claim 33% for the amount over 200. For everybody else, they get to claim 29% for the amount over 200, and your first 200 only gets 15%. So not the world's most complicated schedule, but because it has to cover these oddball situations like capital property and things like that, it's longer than you might think. Okay, so have a look at chapter review problems. Whoop, that wasn't what I wanted. So here. All right, so get back here. Thank you. All right, so for chapter review problem 6-1, we'll go over at the beginning of next class. You'll have the weekend to work with that. So it's Andy Van Holt. He's made some political contributions. He's collecting some EI. So a lot of interesting things going on here. So I think for him, a key question will be, does he qualify for the Canada Workers Benefits? How is his EI going to be handled? There's some charitable donations, lots of stuff for you to sink your teeth into. All right. But on that note, we are quite close to our wrapping up time, so we will come back to 6-1 next time. But here are the main points from today. So today we've looked at the difference between workers' comp benefits and social assistance and how that plays out on the return, how to report CPP and EI on the return, how we deal with repayment of EI benefits. Remember, some of them can be during the tax year and they'll be withheld at source and show up on the T4E. Some of them need to be calculated on the tax return if you have a repayment rate of 30% and if your Box 15 income was over a certain amount. We also talked about charitable donations. A lot more information about that in the textbook, so if you have any questions, just dig into the textbook. Remember, there's more information in the textbook than we can reasonably cover in 3 hours. We also talked about legal fees and where they can be claimed. Again, look at the textbook for more details on that. We talked about other income, which can be, and other deductions. So these, again, miscellaneous income, miscellaneous deductions, which can show up. And then we talked about the Canada Workers Benefit and advance payments for that. For next time, please read Chapter 7, but Chapter Review Problem 7-1 is assignment number 1. This is 20% of your final mark. It's assigned to you now. Do not open it up in ULearn to enter the answers until after next class, please, because it is going to incorporate things that we are going to talk about in our next class. But by all means, read the chapter and you can start to work on paper on this problem. It is due prior to when we review it in class in part 9, and for us that is going to be after Thanksgiving. So there is no class next Wednesday for the Thanksgiving break, I believe, anyway. Right, so our next class will be Chapter 7, then we'll have a class off to allow you to work on everything. Thanksgiving is going to happen, and then when we get back in our next class, we will review it, so you will have had time to finish it by then. All right, so main thing is do not open it in ULearn, because when you do it, starts a timer, and then you just kind of have to put in whatever answers you can. You will not have time to do the assignment and enter the answers while the timer is running. So the entire idea is you work on the problem on paper, get everything finished out so you're ready to answer any potential question, and then and only then open it up in ULearn to answer questions. All right, on that note, thanks everybody, and thanks to all of you listening online. Best of luck with everything. And